सो हेलो गाइस, इम्पल्स कैंडी के एक नए वीडियो पे आपका स्वागत है। कल रात को मैंने एक स्टोरी डाला था इंस्टाग्राम पेज पे, व्हाट आर द टॉपिक्स दैट यू वांट टू सी द नेक्स्ट वीडियो ऑन, एंड अ लॉट ऑफ पीपल voted for the stock market kind of thing because that is the new hype these days. People want to learn about the stock market, people want to learn how to invest in big companies. So let's get started. So before you start investing, here are a few things you really need to take care of. The first point is that you really need to have a really good understanding of the entire stock market. If you don't have a good understanding of the entire thing, you will be losing a lot of money and the outcome is going to be terrible. Second, the stock market cannot be covered in a single day. You cannot become Warren Buffett by just watching this video. Third thing is that you need to be patient. You need to watch the entire video in order to get a good feel of how it works, why the companies actually list themselves on the stock market, and why do we actually invest. So here are a few jargons that you need to get a hold of before you can actually start learning about the stock market. So the first thing is the IPO, the initial public offering. So the initial public offering is the entire process in which a company for the first time lets itself up in the stock market and allows the general public, you and me, to trade on its shares. Second thing, what are shares? So shares is basically one unit of a company's ownership, whatever the profits it earns, whatever the losses it goes through, and whatever the assets it has. Right. So how are the shares created and why are these shares created? So when a company goes public, for example, let's say it requires an investment of $5 million, but the general public, you and me, cannot actually pay a lump sum of $5 million. So what it does, it makes shares of $100 each, which of course you and me can trade on, and then a number of shares are generated which are then listed up on the stock market, and you can actually go and buy any number of shares you want. So shares basically is that one basic unit of investment, of ownership that you can have in a company. Now the third thing is, what are assets? So assets are anything valuable that a company owns. It can be equipment, it can be land, it can be buildings, it can be inventory, any kind of thing. It can even be the brand value. So assets are basically of two types. The first thing is the fixed assets, which is basically the land, trademark, or the brand value, and current assets. Current assets are something that you can easily trade for cash. It can include cash also, and also those things which you can easily trade for cash. You can easily sell, go to the market and exchange it for cash. The fourth thing is liabilities. So liabilities includes all those debts that your company has. It can be the bank loan, it can be the payments that you owe to your suppliers, and it can be also the salaries that you yet need to pay to your employees. So with the basics done, let's move forward. So what is the general mentality about stock market and investments in India? So a lot of people in India, generally a few old people, actually think that the stock market is a gamble, which is entirely not. It's that most of the people go into the stock market and invest without having any knowledge about the entire thing, without having the basic foundation knowledge, and as a result they lose a lot of money and then they tag it as a gamble kind of thing. So a lot of people just go by blind faith. They have no idea what they're doing, and they just generally follow the herd, which is not you should do, because in those cases either you will have a very bad return or a no return altogether, or will go through a tremendous amount of loss and it will be a destruction completely. So there are a set of mathematical analysis tools that you can use in order to predict whether a stock is being overvalued right now, whether it is being undervalued right now, whether its value will increase over time or whether its value will decrease over time. In the market, in the stock market, in the trading world specifically, there are two mentalities which rule. The first thing is the fear and the second thing is greed. These are the two kind of emotions among the people which generally predict whether the price of a thing will go up or whether the price of a thing will go down. So that's the entire game. So why should you invest? First of all, you should invest because you are making money without doing anything. You will be sitting in your room, you will be choosing which stock to invest, and that's all. But it's also not as simple as it sounds, because you will have to gain a lot of knowledge before you invest. You should have a good understanding of how to perform the analysis. You also need to have a good knowledge about which company is doing good, and for that you need to get look on the news every day. You need to watch news on a daily basis. So let's understand the entire stock market with a simple story. Let's say you and your friend start a clothing company called XYZ Clothing Company in your hometown. Now, in order to start that company, you need to have some money. So, what you do is you invest your savings and you go to the banks and take loans in order to start a small store in your town. So, you take that loan and you start building up stores, you start getting that inventory, you start advertising, and slowly you attract customers. After a month or so, you start generating profits and you invest back the profits into your business. So, as a result of this chain, you don't really save a lot. Most of the money that you earn goes back into building the business. After 10 years, let's say you are earning almost $500,000 annually, and you also have a property worth $3 million, let's say. You have paid all your debts and everything is all said and good. Now you decided that you want to expand to other cities as well. You want to create 2 new stores in 2 new cities, right? And after all that planning and financial understanding, you ultimately realize that you need to have another $4 million in order to set up those 2 stores. So you need to get that money, right? But you really don't want to go through that entire cycle of debt and repayment. So what do? So you decide to sell your ownership for that money. How does that work? So you basically go to an investor. So the investor pays the money that you require, and in turn you give up a portion of your company to the investor. So before going to the investor, you first need to understand what is the valuation of your company. How much is your company worth? It's not just how much you're earning, but valuation is something that really depends on the market, and your valuation is going to be completely decided by which market you're playing in and all of other complicated stuffs that you will understand as you get into this thing. So you go to an underwriter and you find out your valuation. So how is your valuation found out? So the underwriter finds out that an average clothing company trades at 20 times its annual earning. So total valuation will be that $500,000 into 20, which will be equal to $10 million, and also you have almost $3 million worth of property with you. So total the valuation is around $30 million, right? So you decide to sell 40% of your company and keep the rest 60% of the company with yourself, because even after this you will be owning a major portion of the company and you will be allowed to take all the decisions on yourself, right? So that 40% of 13 million is going to be 5.2 million. Here I have made a mistake. You can see I have written 60% of 13 million, which is not the case. It's 40% of 13 million. So that is the amount of money that you will get when you trade your 40% of ownership. So now at this stage you can go to an angel investor and you can say, oh, here's the 40% of my company, the net worth is around $13 million. You get 40%, and in return you have to pay me around $5.2 million. And here's something that people don't really understand. Of course you're selling your ownership, but the money that you're getting in return can be used to grow your business, and ultimately you can be worth a lot more than you were previously. So here's the general equation. The percentage into the total value is equal to the amount that you own. So even if the percentage is decreasing, if you increase that value overall, the ownership amount can be also increased. So let's get back. Out of the 5.2 million that you raised, you used 4.2 million and you open up 2 new stores, let's say, and each one earns $800,000 annually. So now the total earning, whatever the total earning is coming from all those 3 stores, is $800,000 into 2 plus $500,000, which gives you $2.1 million annually. You also have 3 stores, so 3 fixed assets worth $9 million total. So now your total valuation will be $2.1 million into 20 plus $9 million, which will be equal to $51 million. So now as a founder, you own 60% of that $51 million, which is almost equal to $30.6 million instead of the previous $30 million, and instead of the previous $30 million. And now you can see that your net worth has increased a lot by giving up a percentage of your company and then taking the investment in return. So now here's another project. You want to expand into 5 more cities, and this time you don't want to go to an investor. You want to apply for an IPO and go public. You want people to trade on your company. So you list yourself on the stock market. Now what the thing is, the public cannot afford to pay $5.1 million upfront. That means you and me individually cannot pay that huge sum of money. So what to do, they divide the entire investment amount into bits and pieces. Like say, as I've already said, the $5.1 million will then be divided into $100 shares each, so that even you and I can trade. So when you own one share, when you buy a $100 share, you own the company's profits, you own the company's losses, and also the assets that it has. So that's how the stock market works. That's why the companies are there on the stock market, and that's why you are actually going and making that trade. A lot of people must have doubts about these basic details of even why the stock market exists, and I hope I've cleared that. So the stock market is a place where you buy and sell shares. You buy at a lower price, you sell at a higher price, and you make that profit. In India, there are 2 stock exchanges, namely the BSE and NSE. BSE is the Bombay Stock Exchange and NSE is the National Stock Exchange. Right. More on this coming up soon. I don't want to tell you everything in a single video because it will all get stashed up in your head and you won't understand everything. So I'll see you again. Till then, take care of yourself and stay home. Bye bye.